Stock prices move up most of the time, but what can you do if you think that's not going to happen for an extended period? Well, even in these sideways markets, it's possible to turn the price fluctuations of stocks into income using a strategy called covered calls or buy rights. In this video, I'll talk about how that strategy works in practice. I'll talk about its drawbacks, but also the kinds of environment where it works best. And I'll finish by talking about some funds which implement covered calls both in the US and in the UK. Now, don't forget, if you do enjoy our content, please do subscribe to our channel and like this video. So let's look at covered calls, strategies for sideways markets in a bit more detail. Now, how often do these sideways markets occur? Well, you can see that they do last for extended periods of time. There are drawdown periods. Some of them are very long. For example, we had two 7-year periods just after the dot-com bubble burst and then after the global financial crisis. But usually they last less than a year. But if they do happen, it can be very annoying as an investor, and it's easy to grow impatient and hope that things would turn around. So if this does happen and you think we're going to be in a range bound or sideways moving market for an extended period, the strategy that we'll consider is called a covered call, or alternatively a buy right. They both mean the same thing. So to use a nautical analogy, this is a little bit like being becalmed in the age of sail. Once the wind dropped, there was just no means of propulsion, and sailors just had to wait for the wind to pick up again before they could get underway. But it's not quite that bad when it comes to investment, because you can get a little bit of a prevailing wind going by using one of these covered calls. So how does it work? Well, just as you would normally, you'll buy a group of stocks or a single stock, but at the same time, you'll sell the upside to somebody else via a derivative called a call option. So why would you sell the upside of your stock? The whole point of buying stock is that it goes up in value and you benefit. Well, if you don't believe in that upside, what you can do is sell that to someone else who does. And today you can pocket that premium from selling the call option. So let's say you do that every month. Well, that way you can generate a steady income and boost your total return, even if markets are moving sideways or downwards. So when does this strategy work best? Well, remember what we've done is to sell that upside to someone else. So if the upside does materialize, if the stock price does surge upwards, well, that's not in our benefit, it's to their benefit, and we're going to pay the price of our caution. So in a strongly rising market, covered call strategies underperform. You'd have been better off just buying the underlying index or the underlying stock. Now, the price of an option depends on how volatile markets are. When they're more volatile, the price of the options increases. So in a very volatile market, which is either trending downwards or sideways, that's when these strategies work best. You'll get the most bang for the buck from selling that upside to someone else. The call options will be very valuable. Now, in fact, that's happened quite recently with the sell-off that we got in tech stocks in 2022. So if we look at the period from December 2021 until June 2022, markets headed downwards pretty fast. And while that happened, you could have actually mitigated your losses by generating income via selling upside. So during that period, the S&P fell by 23%, but if you'd gone for the buy right strategy, one implementation of it, you'd have only lost 11%. If we go back to the financial crisis in 2007, there was a 2-year period when buy rights would have worked very well. This is from October 2007 until March of 2009, when markets turned around. So again, instead of falling 55%, you'd have mitigated your losses. You'd have only fallen 39% due to that added income from the call options. And in the aftermath of the dot-com bubble from March of 2002 to March of 2003, again, you'd have done really well with the buy right strategy. You'd have only lost 11% when the S&P would have fallen 3 times as much, by 27%. If this is all sounding a bit too good to be true, then remember what happens over the long term. So if we zoom out and go all the way back to 2002 till the present day, 2023, you can see that the strategy has underperformed the S&P on its own. And that's because most of the time stocks do go up and selling the upside is a bad idea. So this isn't a good long-term strategy. It's just a strategy for when you think markets are going to trade sideways. So if you're right about that, then this is a reasonable way to invest. If we look at annual performance of this buy right strategy on the S&P versus just holding the S&P, and we look at it year by year, you can see that since 2003, there haven't been that many years when the buy right strategy has outperformed. It's usually been after a crisis when markets have kind of trended downwards or sideways for an extended period. Now, if you like investing for a high income, wouldn't it be great if you had a map of all of the funds available so that you can see which ones generate the highest income? Well, one of our trackers, which is available to our premium members on our website, does just that. So if you zoom in on the section for the US, for example, for the ETFs, their income heat map shows you both JEPI, but also QYLD as offering a large amount of yield. The size of these blocks tells you the assets under management for each fund, and the color tells you how much income it generates. So if you're interested in our membership, you'll get access to all sorts of goodies, such as members-only videos, but also a chat application, so you can ask a question whenever you want. To learn more about that, just go to our website, PensionCraft.com. Now, for those who are interested, we can dig into the financial engineering behind a covered call. The first ingredient is that you buy the underlying stock. Now here I've shown the S&P 500 as if it were a stock, and we bought it at a price of 42.50. Now if it goes up by 1%, we'd gain 1%. That would be our P&L. If it falls 1%, we'd lose 1%. This is a kind of linear relationship between the payoff, the profit and loss, and the underlying stock price or index movement. Now let's contrast that with the payoff for a derivative. In this case, we've sold a call option, and that means that we get this non-linear payoff. The strike price at which the P&L starts going downwards is 42.50, but notice that we're a long way above the x-axis, and that's because of the premium that we took in on day one. Now that's just over $300 in this imaginary scenario, but that profit from selling the call option is the magic behind these yield enhancement strategies. Notice the problems start happening if the actual index goes up a lot, because then we lose our premium and we carry on losing money as the stock price or the index price moves upwards. Now, if we add those two profits and losses together from owning the underlying index and then also having the short call option, what we get is the buy right payoff. Notice that what we've achieved by selling the upside is a kind of capped payoff, where we won't make any more money above a certain level. Unfortunately, however, we've kept all of the downside. It doesn't sound so attractive now, does it? What we've done is we've kept all of the downside and we've capped our upside. But in return for that, we've received a premium up front. And that income is what makes these strategies attractive. If I overlay the buy right strategy with the strategy of just buying the index, you can see the benefits. As long as the index doesn't move up a lot, then we're better off with our buy right strategy. And that's because of the income which we realize up front. So by selling the upside every month with one of these call options, what we're effectively doing is hoping that the underlying index will not go up a lot. If it does, we'll lose. If it doesn't, then we benefit from the continual income. Now let's look at some US covered call funds. Now remember, what you want here is an index which is quite volatile, because there the value of the option will be greater and the income from selling those options is also greater. So the NASDAQ index is a notoriously volatile index. It's also been great for capital growth historically, but one of the strategies which many people find attractive is a covered call strategy on the NASDAQ. And one of the funds which achieves this is created by GlobalX, and it's called QYLD. That's the ticker. Now you can see the description of the fund here, and one of the things to notice is the fee's pretty high at 0.6% per year. And although the yield does vary quite a lot over time, depending on what happens to the volatility of the NASDAQ and also the price of the NASDAQ, but as I make this video, the yield is around 12.5%, which sounds incredibly high. But bear in mind, you are keeping all of the downside of the NASDAQ. So if it does fall, the capital you've invested in the fund would fall as well. But of course, you can apply this to any index. And if you want the NASDAQ, it's called QYLD, as we saw. Global X also has two other funds. If you want to apply the strategy to the S&P 500, the ticker for that is XYLD. Or if you want to apply it to US small caps, you can do it on the Russell 2000 index, and the ticker there is RYLD. In fact, there are many of these covered call funds which are available in the US. And if you look at ETFDB, now called Vetify, you can see this list of those funds. In fact, there's even one for Chinese internet stocks called KLIP, and that has a huge yield of 24%. That's because they're very volatile stocks. Another fund which is really popular in the US is called JEPI. That's its ticker, JEPI, and it's the JP Morgan Equity Premium Income ETF. Now here you can see the yield on that fund as of March 2023 compared with various other asset classes, ones which are usually thought of as high income asset classes. For example, US high yield bonds. Those yielded 8.5% over a comparable period. And a global REIT fund over that same period would have generated just 4.5%. What I also like about this fund is that the expense ratio is pretty low given what it is. It also actively manages the stocks within the fund. It doesn't just buy an index, it chooses stocks which tend to have a high income and which also have a low volatility. So if you don't like capital losses and you like a high income and a low fee, then I think this is a pretty attractive package. You can see why it's had a lot of inflows recently. And JEPI breaks down the income it generates into the income from the stocks it buys, which is around 1 to 2%. Of course, it varies over time, and the income from the covered calls, which it writes on the stocks it buys, which is an additional 5 to 8%, again, depending on the volatility of those stocks. Now let's look at covered call funds, which are available in the UK. There isn't that much choice for UK investors. There used to be lots of funds available from BMO, but those were withdrawn. But there are two from Fidelity, which you can see here. One of them does a covered call strategy on UK stocks. That's the Enhanced Income Fund at the bottom. And the other one is a global fund, which takes MSCI World developed market stocks. And in both those cases, it tries to boost the income on the underlying index by around 50%. Now, recently on a YouTube Live, somebody told me in the comments section, do you know that QYLD is now available to UK investors? So I checked and it was. I was really excited. So here's Global X's European site. And what is different about this description is that it has the word UCITS before the word ETF. UCITS stands for Undertakings for Collective Investments in Transferable Securities. And really that's just a stamp of approval by European regulators for a given fund. So this is the UCITS version of QYLD. Now it turns out it's difficult to find all the information about this fund in Europe, but it does say that it trades two versions on the London Stock Exchange. One of them has a ticker QYLD, that trades in dollars on the London Stock Exchange, and the other one is QYLP, which trades in sterling. Now for both of those you'll be taking the currency risk. For one of them it'll be implicit, that's the sterling one. For the other one it'll be explicit because you'll see it trades in dollars. So if sterling does strengthen versus the dollar, both your income will fall and also the value of your fund will fall. Conversely, if sterling weakens, it'll flatter the income and the value of your fund. Now, there was also some confusion about whether these funds pay monthly or semi-annually. Some of the data sources I saw said semi-annual, but if I look at the regulatory filings on the London Stock Exchange, sure enough, it says, as you can see here, that it's paid monthly. If it's an income fund, that's what you prefer, presumably. You want to see that income every month. You don't want to have to wait 6 months to get hold of the income from selling those call options. So I hope that's given you a bit of an insight into how covered call strategies, or alternatively buy rights as they're called, work, and the kinds of environment where they work best. But remember that over the long term, these are not buy and hold strategies. They will underperform the underlying index. So it is best just to hold an index for a long period of time and make money out of that upward drift very cheaply. Now don't forget, if you do want to learn more about investing, we have our membership offer. And if you want to become a premium member, just go to our website, pensioncraft.com. And as always, thank you for listening.